Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey everybody, sorry about being a couple minutes late. Had a computer problem. Okay, good afternoon. This is Tuesday Tech Talk. My name is David Blake, and we're going to quickly review the last couple of days, try to figure out what's going on with the market, and then we're going to look at some of the different sectors and indexes and see where some areas of support and resistance might be. We'll talk about 20-25 minutes, and we'll open it up to you guys and talk about individual stocks, maybe some different industries, anything that's on your mind. Okay, we've been calling, let's just get rolling here. We've been calling the current market a counter-trend rally against the major trend for the market, which is still considered down for the last few weeks now. As of the close on Monday, we're beginning to take out some of the resistance areas, and actually several indexes are closing in now on their 200-day moving average, and they've actually crossed above their 100% or 100-day moving average. Also, we have gotten several of the indexes have actually retraced 50% of the move down from last November to the February 11 lows. Of course, the Russell 2000 and some of the other indexes or sectors actually bottomed on the January 20th. But what we want to look at today, we're going to call the three I's, and that are see what they can tell us about the current rally. And that's indicators, internal breadth, and investor sentiment. And what we want to do is we want to look at, by measuring some of these with the indicators, we can see what kind of momentum the market has behind it, look at the trend indicators to see whether we actually are trending. We also want to look at some divergence in the indicators to see if they might be calling for a temporary top. And we'll also look at some of the resistance areas and moving averages that we're taking out and bouncing off of. As far as the internal breadth goes, we want to look at whether the market's under accumulation or distribution. We'll look at the NYSE and NASDAQ AD lines, check out the new 52-week highs and lows on the different indexes, look at the McClellan oscillator, and also how if volume's confirming the move higher. And lastly, we'll look at investor sentiment, which is actually a contrarian indicator. We want to see how the bullish investment advisors percentages are and varies. Look at the fear and greed index, the VIX, and actually even the public specialist ratio to see what's going on the floor, and actually also short interest. Okay, what we want to do first is we're going to look at the Dow Jones over here, see what's going on with that. First off, it's kind of a busy chart over here, but let me grab my arrow. Because you can see over here, first off, is we're close to retracing actually 61.8% of the move down from the high down to the low. Generally, once it crosses above the 61.8%, which is a Fibonacci retracement level, you usually get a full retracement of the whole move down. So that is actually pretty bullish. As soon as we cross above this 17,175 area, which also represents the 200-day moving average, you can probably figure that we're going to get at least a run almost to the new highs. You still have a descending trend line coming up here around 17.4, which it has to break through. After that, there isn't any resistance going forward. As far as the indicators go, a couple of weeks ago we talked about the 14-day RSI, whether it's overbought or oversold. But another thing that you want to watch on the RSI, especially the 14-day, is whether or not the index, the oscillator can get above 70. If it can get above 70, that's actually bullish for the broader market, because that means you're actually in a bullish trend. You want to also see that stay above 40 on pullbacks. You also look at the on-balance volume on the Dow, so you're seeing some good accumulation coming in here. The MACD is also is bullish on that. I don't see any negative divergence on any of the indicators yet. Typically, if we were ready for a pullback on a current rally, you would start to see maybe the 14-day RSI starting to top out, or maybe maybe the short-term MACD starting to roll over. But I don't see that yet. So it means that despite today's little pull down, which isn't much. I mean, we're down triple digits. Now you're down 46, and most of the damage today has been in the the stocks and sectors that ran up, on the materials and energy, that kind of thing. But we're down 46 points in the Dow, not bad at all. Transport's taking a little bit harder on the chin. But as far as the Dow Jones goes, it looks good at this stage. Okay, if you look at the S&P 500, it's going to show us a lot of the same things. We're above the 100-day moving average over here, right around 2,000. We're right at the 61.8% retracement level on the fib chart here. You want to see that cross above that. And once we get above that level, you've got both the 200-day moving average and this descending trend line to battle it out there. That's going to be about 2030 to 2035. Up-down ratio looks good over here. You are seeing some good accumulation, so that's bullish. MACD is bullish. 14-day RSI, again, is over 70. Although it's overbought, that's bullish. And again, I don't see any negative divergence. It tells me that this thing's going to roll over anytime soon. Next, we'll look at the NASDAQ. Not quite as strong. We got above 50% retracement level over here, and also above the 50-day. But we're kind of struggling going sideways here with this, with the 50% retracement. That's right around 46.90. That's where we are right here again today. We're kind of holding on to that for support. We're down 22 points on the NASDAQ. But I think unless that thing breaks down below here and comes back down to test this 46, it looks okay. Not as much accumulation in the up-down ratio, which means that you're not quite getting the participation. But the RSI is above 70. That's bullish. And again, you have the MACD is also bullish. So I like that. I don't see any signs that that's going to slow down yet. Okay, next one we have the Dow Jones, the Russell 2000. As far as the Russell 2000, it's outperformed off the bottom, and we've retraced 50% of this move off here. In fact, off of the lows for the Russell 2000, we're up about, I think about 18%, something like that. So 1156, let's see, is around resistance for the 200. Wait, hold on, I'm on the chart here. Okay, 1080 was the 50% retracement. We did break above that. We're holding above that today. We want to see this coming up here around 21, actually around 1200, 1100. That would be the 200-day moving average, or 100-day moving average. And if we can get above that area, then you have another shot up to the descending trend line at the 200-day moving average. Good upward slope on up-down ratio. RSI, again, you're very overbought, but you are up around 85 or so, which means that we're in a bullish trend. MACD is also bullish. So a nice move off of this low in here. We don't see any negative divergence either on that, which means we may have a little further to go. Transportation index, which we talk about a lot, as we hope it could possibly lead the other indexes back into the bull frame. You're looking over here. We're up here bouncing off the 61.8% Fibonacci retracement level. We did get across the 100-day moving average. We actually have fallen below that today because we're down about 120 points at around 75.64. So you want to see that recoup that over the next day or so. Up-down slope looks good. RSI is above 70, and MACD is also bullish. So that, again, also looks like it has some work to do to the upside. We'll see what a real battle is up here around the 200 and the downward descending slope. But I think that right now, as far as the charts are looking, looks like we got a little bit more to the upside. Okay, now let's see what the internal breadth is telling us about this market move. First thing we have here is the NYSE advanced decline line. As you can see, this has been a real rocket shot off of the lows here in September. Now, this is considered a leading indicator because it tells you whether the underlying move is supported by a lot of stocks or maybe not as many. Over here, when we were making lower lows and lower highs, the market was kind of going sideways. We thought we were telling you that was bearish. The way we thought was going to go lower. Now, this has picked up about 17,000 units off of the lows. The old highs from last summer was around 335,000. So this is certainly not negative divergence. This shows that it's a widespread rally, and we could go a little bit higher. NASDAQ, not quite so much, but again, it is taking out the old high here. I'd like to see this thing move up a little bit more. but it's not showing negative divergence at this point either. In fact, if you drew a trend line, you can actually draw trend lines on these kind of charts also. You actually broke above that, so we're down about 25 points today, and the AD line's not that bad. I think it's about just a little bit under flat. So that's to me it's neutral to bullish on that. Okay, over the last this is the NYSE new high new low chart. Over here on the green line, you can see when we were making the new lows. You were up here around 1,300 new lows on the NYSE. A couple of months ago, you were around 650. Just in the last probably 2 weeks, the new 52-week highs have outperformed the new lows. But unfortunately, we're still only at about, we're making about 80, 50, 60, 70, 80 new highs versus lows making about 15 or 20. So that's really come off. I'm going to have to give this, mark this as neutral, however. You want to see this on a decent market going up in the, at least triple digits, and we're not anywhere near that yet. Like I say, we're around 80, 75 or so. This needs to move up a little bit more. You can find these charts on the home page of Market Edge when you go to Market at a Glance up in the right-hand corner. Okay, here's the NASDAQ new high, new low. This is neutral to bearish, actually, to me. Just in the last 3 days is the first time you've made more new highs and new lows on the NASDAQ, and you're making about 30 to 40 new highs versus about 20 to 30 new lows. So we're not seeing a broad participation yet on this NASDAQ new high, but we're, it's trying. You want to see some improvement in this before you can see this market really taking off again. Okay, another thing we want to look at is what are the professionals doing at this point? Okay, this is the weekly. This is the weekly bullish percentage of advisors. When this thing gets down around, we get down here around 30. Let me just find my notes on this thing. Okay, when the bullish advisors get below 40, that's usually this is another contrarian indicator. That's going to be bullish. When it gets above 55, that means they're overly bullish, and that gets bearish. So we got down to about 25 on this indicator back in February. That was kind of an extreme level. We also saw that back there in August or September. Also, they got down around that level back in 2011 in October. So that was an oversold thing. These things work best when they reach extreme levels. And back in February, that was kind of an extreme level for this thing. We're still bullish on this one, meaning they're still a little bit too bearish at this point. Once we get up here around 50, we can start to start looking at that being more bearish. As far as the advisors that are actually bearish, this peaked up here around 40, which was still neutral, but we're coming down here now to around 30. If this thing gets under 20, that would signal that the bearish advisors are too few, and that would end up being bullish for the market at that point. But at this point, it's still narrow. And the reason these are contrarian indicators, if you look at over here, if all these guys are bearish, it gets down here around the 20s, that means they're in cash, which means they're going to put a lot of cash to work. When this thing gets up here around 55, that means they're fully invested, so they don't have a lot of money to move the market much higher. So that's why when you look at these, you want to go the opposite of what they're actually telling you. Okay, before I get to the sectors, some of the other things that we look at as far as what's showing bullish or bearish right now, kind of look at the McClellan oscillator. It kind of is an accumulation thing. It looks at the difference between a 19-day and 39-day exponential moving averages of advancing minus declining issues. Buy signals are triggered when we get up around 700 to 1,000. Sell signals when it rises to about 70 or 7,000 to about 10,000. Right now we're at about 327, which is basically neutral on that. McClellan Summation Index is also it's more of a shorter term reading. When it crosses zero, it gives you signals. In this case, we've got once they cross zero and start to expect a higher, you come in around you came in at 552 last week or 2 weeks ago. Now you're at 2009, which is signaling that we're overbought. So that comes in bearish on the list. And let's see. Furthermore, we're looking at the dividend yield spread, which is right around 1. That's bullish in here. VIX is still in neutral ground, and the put-call ratio is also neutral. but that's trading right about at 1. You want to see that also reach extreme levels, which we don't see currently. Okay, so let's take a look now at the sectors. We want to see which ones are participating in this current rally and how far they've come off of the February lows. First, we want to look at is the consumer discretionary sector. This would be the retail stocks, some of the restaurants, that type of thing. We see up here we've had a run up here to right at the 61.8% retracement level. It's kind of backed off that a little bit today, not much, but we're also right here. This 100 and 200-day moving average and that 61.8% retracement are all right here at the same time. If it busts through that, these stocks like Home Depot, Costco, some of those Alta Salon, some of those, they don't really have any resistance up here until we get up near the old highs. So what looks bearish on this, a little bit of negative divergence on the up-down ratio. It is slightly up, but you can see there's an awful lot of selling in this thing right now, and you don't see this thing actually leading or confirming the move higher in this sector. However, the RSI is above 70 and looks good. It's overbought, and the MACD is also going. So I like this, especially if you see on the next rise in the market, if it can take out this 61.8% retracement level. Okay, the next one is the energy level. It's actually up about 24% off of this low, and it bottomed out right around just a little bit before the broader market on that one day when it washed out. Okay, we've come up here now. We've just crossed over the 50% retracement level from the move down here in November. We hit resistance up here at the 100-day moving average, and today we're off about 3.25%. So you probably come back down below this 50% retracement level. You want to watch that. If we have a hard time getting back up above this $35, $36 area on crude oil, that could spell trouble for this, and you might see this come back down a little bit. But right now, like I said, the battle is up here, but the next battle a little bit higher on that. We have the financial sector, which is up, let's see, financials are up about 14% from the bottom. It's struggling to hold this 50% retracement level also. It finally got above the 50-day. Today we're off almost 1%, around 22 or so. So it's back below the 50% retracement level. You want to watch that. Accumulation is okay, probably neutral on that, but RSI is strong and MACD is strong, which to me is bullish. Okay, the next one is the tech sector. And the technology sector, it's underperformed a little bit. It's up about 11% off of this bottom. This is a busy-looking chart with all the indicators kind of coming together all at the same time. This actually looks pretty good in the fact that you've actually crossed the 100-day and the 200-day. You've also crossed the descending trend line up, coming down here from the highs, and we're battling to get above this 61.8% retracement level. It's actually up today because, like I said earlier, most of this selling today is off of the stocks that really ran up the last week or so. That's the steel mining stocks, your gold miners, your oil-related stocks, and also a lot of your commodity stocks. And also, as far as negative divergence, a little bit of negative divergence on the accumulation on this, which means some of this move up here is not supported by a wide, the broader market. It may be getting a little bit narrow at this time, but RSI is still bullish, and MACD looks bullish in here also. Okay, here's the industrial sector. This actually, this thing's up about 15% off of the bottom, and it ran into resistance right here at the descending trend line going back from last summer. So that's something to watch, but you did clear the 200-day moving average here last week. That's bullish. The up-down ratio looks good in here. You're seeing some good accumulation. A lot of this actually is after the Fed backed off of saying they weren't going to raise rates as quick. That helps. That brought the U.S. dollar back to a trading range, and that would help the industrial spiders, especially with the international exposure. So if they can break above this descending trend line, you're probably going to retrace the whole move down from this level, and that might be somewhere we can look, especially unless they start talking about raising rates again. Okay, next one's the healthcare spider. This doesn't look as good. We're stuck right here at this 50% retracement level off of the highs from last fall. It did get, it's actually struggling to get across this 50-day also. It got above it, I believe, yesterday. Today it's down about 0.5%, so you're still going here. But as far as up-down slope goes, you're not seeing a lot of participation here. One of the problems with the healthcare sector is the biotechs were just hit hard. And then all the talk about the drug pricing issues have kept the lid on this sector. Once you see this thing maybe cross above this 100-day and break above that 50% retracement, you might start looking at the healthcare sector as a place to go. The last two we're going to look at actually happen to be having a great day today despite what the broader market is doing. This is consumer staples. Times a little bit rough. You know, people like the booze, they like cigarettes, that type of thing. This is going out to new highs. You're actually probably making another new high today because we're up about 0.75%. Everything that's good on this, you've got a rising trend line by coming up. You're above the 200-day, the 50-day, the 100-day. Accumulation, not quite as broad as you'd like to see, but the other indicators look bullish. I think you can look at stocks in this thing as, even though it's a defensive sector, unless the broader market really takes it, breaks out and starts looking at new highs, this is probably where you want to go on pullbacks. The last one we're going to look at is, this is actually a question. The last one I wanted to look at before we go on is utility sector, and it's actually up another 1% today. It's actually breaking, the Dow Jones Utility Index is actually making new highs again, very strong. It's actually, the utility index is up about 5.5% today alone. Or no, I'm sorry, it's up 1% today, but it's up to 636, 642 today. So again, it's making new highs. That's another place that if the market begins to break out to new highs, you'd want to probably start to sell some of those stocks. Okay, I had a question here about some of the stocks that are really, but before I get to the questions, let me wrap it up this way. Okay, over the next 2 weeks, you're going to have the European Central Bank, the Bank of Japan, the Federal Reserve all meeting to try to see what they can do to stimulate the economies. So there's a good chance that on these pullbacks that you may get another 2 or 3 point move that could knock these markets through these resistance areas. It depends if they give the market what they want. If they come up short and say we're going to leave, like if ECB comes in or Bank of Japan doesn't do anything by cutting rates, that could give us a little bit of a knockdown on that. Another thing is the Federal Reserve will meet next Wednesday. They'll read their statement. One of the things that has me a little bit concerned in here is that now that the market's kind of bouncing back, especially if we get a big bounce from the ECB or Bank of Japan on them going further into negative rates, the stronger our market looks, probably the Federal Reserve probably will up rates sooner than later, and that could be a little bit of a problem going forward for that point. What kind of boost we get, you just have to watch. If you see them come in and they cut rates further to negative ground, the market goes up 300, don't be surprised. If they come in, they don't do anything, and the market goes down 300, that wouldn't be surprising either. But anyway, according to FactSet, we've got 2 more quarters of negative earnings and revenues going forward. You also hear that people say that China doesn't matter anymore. A lot of today's selling today in gold, or not gold, but in the energy and materials sector is basically because China came in today and said that their exports were down 25% for last month. They're looking for a fall of about 14%. So, the oil trade to me seems like it's very dependent on China numbers coming in stronger because we're certainly not getting a big rise in oil here based on our economic numbers. I had the big jobs report last week. We had 242,000 new jobs created. I think I read where about 158,000 of those were basically restaurant workers and in the service industry. So these aren't high-paying middle-class jobs that we're getting. Then another question we had before I wrap this up, we've got a nice tradable bounce off of in these indexes. We wouldn't get too greedy. We do also go to a sell on the CTI, which is slated to go bearish either the week ending March 25th or possibly even as late as April 1st. So I think you've got some more work to go on the upside with the current rally. Maybe we get to about the 200-day moving average, and then we'll start to look at things. Okay, someone had a question on the stock NUGT. They wanted me to take a look at it. This is a double on the gold miners bullish stocks. You can see we got a nice upward trend going up here. We broke out the new highs yesterday before the day before we started to take some profits on that. Today's rally, or I should say selling off, is actually in the gold miners. It's in the oil-related stocks, in the steel stocks that have really outperformed over lately. Now, what I don't like about this chart, on the 14-day RSA, I'm starting to see some negative divergence. You're making going up here to new highs, but you're seeing the 14-day RSI starting to slip down here to about 55.60. That's negative divergence. You also see the 30-day stochastic. This is actually a 14-day stochastic starting to come down a little bit too. So I would be careful in here. I think you can probably get another trade up here, up a little bit higher, but I wouldn't ride these things too long. Just keep your eye on the GLD or how gold is. I have a target on gold of about $1,300 an ounce. If the market would roll over a little bit, I think the next target would probably be about $1,400. Okay, last question before we open it up to you guys. If you have any questions, we'll start typing them in now. Someone said, why do so many of your upgrades in Market Edge come up when they come in overbought? All right, the reason that statement accompanies a lot of the upgrades to long is based on the stochastic being above 80, especially the slow stochastic. And here's how you can fix that. Stochastics are very useful when stocks are in a trading range. If you were going to trade this thing right over here, this is going sideways. When the stock got up here to the top of the range, stochastic was in around 80-something, you would consider selling it. When it comes down here to the bottom of the range, gets below 20, you would consider buying at that point. However, if you look at a chart and you go in here and you can draw a nice rising trend line on something like that, that means that the market or the stock that you're looking at is in a bullish trend. Now, stochastics are going to keep you out of trades when you're looking at a bullish trend. Actually, when if the stock is moving up like this over here, you get stochastics over 80. It's actually for traders, it's bullish because what they're looking at is it's trending higher, and because it's trading at 80, it's staying at the upper end of its trading range, and you're going to move higher. So when you get that stock is overbought on an upgrade to long in the Market Edge, take a look at the chart and see if it's trending higher, then I would ignore that and I'd go ahead and buy the stock because the stock can stay overbought if it's trending for 6 months if it's strong and the conditions are all in place. So one other question just came in here: how can I get my slow stochastics to match what Schwab has on their stochastics? Okay, the stochastic that we use on the second opinion report and default stochastic oscillator on Smart Chart is the slow stochastic is a 5-day. Most charting packages use a 14-day for the slow stochastic. So if you want to try to match it up with some of the other packages that you use, just change ours out to a 14-day. But the report is still going to be based on a 5-day moving average. Okay, we got a couple questions coming in here. I'm going to close this down so we can go to the charts. Pull that up. Let's get the questions first. Okay, RSI has peaked and retracing in all indexes. Isn't this an indicator that support for a run has ebbed? Yes, you want to look at the 14-day RSI for negative divergence. That's a sign that these indexes have peaked. They don't usually. I don't see the negative divergence yet. Not enough to where I'm going to. It's a red flag to me. I think you still have some upside potential. Now, if I would see the RSI go from 70 down to about 60, then what you want to see is you want to see the index or stock making a new high, while the RSI goes from 75 to 60. That is negative divergence. If the index has a bad day, comes down 100 points, and the RSI rolls over, goes down 10 points, that's not negative divergence. That just means that the strength of the rally may be pulled a little bit. To the next update, it's going to reverse itself. So not until you have to compare it to if the index is making a new high. And I don't see the RSI peaking at the same time, turning down as the as the markets are making new highs here. We've been up 5 days in a row on the Dow Jones, the S&P 500, and when you look at this chart, you're going to see that the RSI is still making new highs also. All right, what about stocks exceeding buy stops? How many more does it take before a rating change takes place? Okay, what you want to see on that is you want to see when a stock goes above a buy stop, that is an area of resistance. But what you also want to see to make it go to an early entry buy is you want to see the U down slope go positive, which means that not only does it take out this resistance area, now you're also under accumulation. So you don't want to be buying this just because it jumps up on and goes above the buy stop. If the up-down ratio is or slope is still negative, that would give you a little bit of a red flag. And Nick Padula wants to talk about stocks. He said that. Okay. Let me run over the chart. Do we have any more questions at this point about any individual stocks or anything that you're looking at? Okay, I don't see. I've gone past the 30 minutes again, so I'll try to get out of here fast. But again, if you have questions during the week, send them in to Dr. Market Edge, the doc at support@marketedge.com, and I'll try to get to them on the next webinar. Again, I think this thing is pullback today will probably be bought. It looks to me like we're going to work our way a little bit higher over the next week or two. So I wouldn't get real greedy because I think we will probably get a run up to the 200-day moving averages. At that point, you may want to lighten up. Again, look at the indicators for some divergence. Like the question said, if we're making new highs and you see the RSI starting to roll over, that's telling you that we're running out of gas a little bit up here. Okay, Rio, doses dropped today have anything to do with overbought? I believe that's an oil stock, isn't it? Rich, can you check see what RIO is? Okay, here's RIO. Is it an oil-related stock? Okay, on the RIO, it's an industrial and metal stock. No, it's not really a mining stock. All the mining stocks have pulled back today. Part of that is because of the just the pullback in energy, which is causing oil, but it's causing the materials and everything to go. I think when you have the here's Rio. When you have some of these stocks that are up 20, 30% in less than a week, of course, the people are going to be taking money off the table. I think they still have some work to the upside to go. You take out some good resistance levels. RIO is down probably today, I would guess, just just because the other stocks are. Today it's 9%. Okay, you're down about 9% today, unless there's been some news coming out, which I don't see. Unless you got a downgrade by Vail. You did have a downgrade on some of the miners. I think it's probably valuation because they run up so much. But a lot of these things, keep your eye on gold. As long as gold stays steady to higher, the mining stocks will do all right. And the crude oil advance is also helping. You're looking at copper going up and all that too, a lot of the materials. But don't forget also this China thing. Again, a lot of the what people are looking for is what we're going to see out of China. China falls out of bed or slows down. That's a little bit tough on these stocks that are looking for mining, copper and all that kind of thing. But I would think that this RIO, I don't think it's. I think it's just because of a little bit of valuations. It's run up from about 25 to 32 in a week. So you're seeing accumulation, and I don't see any negative divergence in other parts. Hey, I've gone too far. This is 40 minutes again. I thank you for joining us. Again, get questions in early, and we will see you next week. And hopefully, we'll go up here the next week or so and test these 200-day moving averages, and then we'll look at it next week. Thanks for joining me.